Bitcoin ETFs became one of the biggest developments in cryptocurrency when the United States approved spot Bitcoin ETFs in January 2024. These products brought Bitcoin to mainstream investors through traditional brokerage accounts, saw billions in inflows within months, and represented a major shift in institutional adoption. In this video, I'll explain exactly what Bitcoin ETFs are, how they work, spot versus futures ETFs, who offers them, the advantages and disadvantages compared to buying Bitcoin directly, tax implications, fees, and whether Bitcoin ETFs are right for you. Let's dive in. A Bitcoin ETF is an exchange-traded fund that tracks the price of Bitcoin. Like any ETF, it trades on traditional stock exchanges during market hours. You buy shares of the ETF through your regular brokerage account, just like buying stocks. The ETF's price moves up and down based on Bitcoin's price. This lets investors gain Bitcoin exposure without dealing with cryptocurrency exchanges, wallets, or private keys. Two main types of Bitcoin ETFs exist: spot and futures. Spot Bitcoin ETFs hold actual Bitcoin. The fund buys and stores real Bitcoin, and each share represents a fractional ownership of that Bitcoin. When you buy a share of a spot Bitcoin ETF, the fund holds equivalent Bitcoin backing that share. Spot ETFs track Bitcoin's price closely because they own the underlying asset. Futures Bitcoin ETFs don't hold actual Bitcoin. Instead, they trade Bitcoin futures contracts. A futures contract is an agreement to buy or sell Bitcoin at a specific price on a future date. These ETFs roll contracts forward as they expire, which can create tracking errors and additional costs. Futures ETFs existed before spot ETFs were approved, but they're less efficient at tracking Bitcoin's actual price. The approval of spot Bitcoin ETFs in January 2024 was a watershed moment. The SEC had rejected spot Bitcoin ETF applications for over a decade, citing concerns about market manipulation and investor protection. Finally, after Grayscale won a court case challenging the SEC's rejections, the agency approved multiple spot Bitcoin ETFs simultaneously. Major financial institutions like BlackRock, Fidelity, ARK Invest, and others launched products. These spot Bitcoin ETFs saw unprecedented demand. BlackRock's IBIT and Fidelity's FBTC attracted billions in assets within weeks. The products made Bitcoin accessible to financial advisors, retirement accounts, and institutional investors who couldn't or wouldn't buy Bitcoin directly. Daily trading volumes reached billions of dollars, making Bitcoin ETFs some of the most successful ETF launches in history. How spot Bitcoin ETFs work operationally is straightforward. Authorized participants, typically large financial institutions, can create or redeem ETF shares. When demand for ETF shares increases, authorized participants buy Bitcoin on the open market and deliver it to the ETF in exchange for newly created shares. When redemptions occur, the process reverses. This creation and redemption mechanism keeps the ETF's price closely aligned with Bitcoin's actual price. The ETFs store Bitcoin with qualified custodians. Coinbase Custody is the primary custodian for several major Bitcoin ETFs. These custodians use institutional-grade security, including cold storage, multi-signature controls, and insurance. While this reduces but doesn't eliminate custody risk, it's generally more secure than individuals managing their own keys without proper knowledge. Advantages of Bitcoin ETFs over direct Bitcoin ownership are significant for many investors. Simplicity is the biggest benefit. You buy and sell through your existing brokerage account. No need to set up accounts on cryptocurrency exchanges, go through KYC verification, or learn about wallet security. For investors already comfortable with stock trading, Bitcoin ETFs remove all cryptocurrency-specific friction. Regulatory oversight provides comfort. ETFs are regulated investment products subject to SEC rules. The funds must meet disclosure requirements, custody standards, and operational guidelines. This regulatory framework provides investor protections that don't exist in unregulated cryptocurrency markets. For institutions and risk-averse investors, this oversight is crucial. Tax reporting is simpler with ETFs. Your brokerage provides standard tax forms showing gains and losses. You don't need to track every Bitcoin transaction across multiple exchanges and wallets. For accountants and investors dealing with complex tax situations, this simplification has real value. Traditional, long-term, and short-term capital gains rules apply just like stocks. Access through retirement accounts is another major advantage. Many investors want Bitcoin exposure in IRAs or 401ks, but couldn't easily do so before ETFs. Now, Bitcoin ETFs can be held in tax-advantaged retirement accounts through standard brokerage platforms. This makes Bitcoin allocation part of long-term retirement planning without exotic self-directed IRA structures. However, Bitcoin ETFs have significant disadvantages compared to owning Bitcoin directly. You don't actually own Bitcoin when you hold ETF shares. You own shares of a fund that owns Bitcoin. This means you can't transfer your Bitcoin to a wallet, spend it, use it in DeFi protocols, or control the actual asset. You're dependent on the fund structure and custodian. Fees reduce returns over time. Bitcoin ETFs charge annual management fees, typically ranging from 0.2 to 0.25% for the major spot ETFs. This might seem small, but it compounds over years. If you hold Bitcoin directly, there are no ongoing fees beyond the initial purchase costs. For long-term holders, these fees represent a meaningful drag on performance. You don't control your Bitcoin with ETFs. The fund holds the Bitcoin. If something happens to the fund, custodian, or there are regulatory changes, you're exposed to those risks. With direct Bitcoin ownership, you control your private keys and assets. Not your keys, not your coins, as the saying goes. ETFs violate this principle of self-sovereignty that Bitcoin was designed to enable. Trading hours are limited. Bitcoin trades 24 hours a day, 7 days a week. Bitcoin ETFs only trade during stock market hours. If Bitcoin moves significantly overnight or on weekends, you can't react until markets open. This creates timing risk and means you might buy or sell at prices different from Bitcoin's actual current price. Counterparty risk exists with ETFs that doesn't exist with direct Bitcoin ownership. You're trusting the fund, sponsor, custodian, and various service providers. While these are regulated entities with strong reputations, they're still third parties. Direct Bitcoin ownership eliminates all counterparty risk if you properly secure your own keys. For choosing between Bitcoin ETFs and direct ownership, your situation matters. Bitcoin ETFs make sense if you prioritize simplicity and already have brokerage accounts. If you're investing through retirement accounts, ETFs might be your only realistic option. If you want regulatory oversight and standard tax reporting, ETFs provide that. If you're uncomfortable with cryptocurrency technology and self-custody, ETFs remove that barrier. Direct Bitcoin ownership makes sense if you value self-sovereignty and want actual control of your assets. If you're comfortable with technology and willing to learn proper security practices, direct ownership provides full control. If you plan to use Bitcoin for anything beyond holding, like sending payments or using DeFi, you need actual Bitcoin. If you're in it for ideological reasons, about decentralization and financial sovereignty, ETFs miss the point. For most mainstream investors who simply want Bitcoin exposure as part of a diversified portfolio, Bitcoin ETFs are probably the right choice. The convenience and simplicity outweigh the disadvantages of fees and lack of direct ownership for this use case. For crypto enthusiasts, long-term holders, and those who understand the technology, direct ownership provides more control and aligns better with Bitcoin's philosophy. Tax treatment is similar but has nuances. Bitcoin ETFs are taxed like stocks with standard capital gains treatment. Selling ETF shares triggers capital gains or losses. Bitcoin held directly is also subject to capital gains tax, but every transaction, including spending Bitcoin, is a taxable event. This makes direct Bitcoin ownership more complex from a tax perspective for those who actively use it. The major Bitcoin spot ETFs as of 2026 include BlackRock's IBIT, which became the largest by assets. Fidelity's FBTC is another major player. ARK and 2-1 shares ARKB, Bitwise's BITB, and several others compete in the space. These products have similar structures but vary in fees, with competition driving fees down over time. Early entrants charge 0.25% or more, but fee pressure has reduced costs. Futures Bitcoin ETFs still exist but are less relevant now that spot ETFs are available. The futures products have higher fees and worse tracking due to the mechanics of rolling futures contracts. Unless there's a specific reason to use futures exposure, spot ETFs are superior for most investors. International Bitcoin ETFs existed before US approval. Canada approved Bitcoin ETFs years earlier. European markets have various Bitcoin investment products. The US market is largest, so US spot ETF approval was the most significant global development, but Bitcoin ETF products are available in many jurisdictions with varying structures and regulations. My honest take is that Bitcoin ETFs are a positive development for Bitcoin adoption and accessibility. They bring institutional capital, mainstream investors, and regulatory legitimacy to Bitcoin. However, they don't replace direct Bitcoin ownership for those who value self-custody and want to actually use Bitcoin. Both have roles. ETFs for simple exposure in traditional accounts, direct ownership for control and full Bitcoin functionality. Choose based on your goals and comfort with technology. If you found this explanation helpful, make sure to subscribe. In the next video, I'll teach you how to evaluate and spot good crypto projects, separating legitimate opportunities from scams and hype. Thanks for watching, and I'll see you in the next one.